The money is broken. The money was always broken. It's been broken for 100 years, losing 7 to 10% of its value. But in hyperinflating economies like Venezuela or Argentina, fill in the blank, the money loses 20, 30, 40% of its value a year, sometimes 80% of its value a year. In that case, you can't even carry money for a decade. You might not be able to hold money for a year in those economies. The Russian ruble's lost 35% of its value in the past few weeks, right? That's how fast it collapses. So fundamentally, we have this issue. I want to move money through time. I have a 100-year time frame. I'm an institution. The whole point is an institution is supposed to go on, right? And so how do you do it? No currency will work. Can you use gold? Well, gold as money is the best idea humanity had for like 5,000 years, but it's not a perfected idea. The problem with gold is gold miners produce 2% more gold a year.
Bitcoin has seen new volatility in recent days following Russia's invasion of Ukraine, which has influenced the crypto and stock markets. Although Bitcoin's price has surged and crossed the $40,000 mark, it is still far from its all-time high in November last year. But still, fears persist among a continuing inflation surge, the stock market's worst month since March 2020, and ongoing signals that the Federal Reserve will begin raising rates at its next meeting in March in an effort to counteract inflation. Despite this, Bitcoin bull Michael Saylor says that Bitcoin could fight cyber attacks against Ukraine. Hello and welcome to Money Talks. In today's video, Bitcoin evangelist and CEO of MicroStrategy Michael Saylor updates on Bitcoin's status as a reliable asset, downsides of owning gold and real estate, and importance of Bitcoin in building a portfolio. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Also, make sure to stick around to the end of this video as Michael Saylor shares his exclusive insights on Bitcoin as an integral part of MicroStrategy's portfolio. Let's dive right into the video.
You know, most people don't think about money, and we just kind of take it for granted. And I really took it for granted up until about 2020. But I think in March of 2020, a lot of people's worldviews were shaken, right? I had some deeply held beliefs. You know, one belief is everybody should work in an office, and you had to come and show up and work in the office. And then during the lockdowns, I found that I had to question that belief, and pretty soon we're all working remotely, and I, along with probably a billion other people, went through that same transformation. So that was like a digital transformation of work. In the second quarter of 2020, we had what we'll call a K-shaped recovery. But in my opinion, the K-shaped recovery was Main Street got shut down and locked down, and if you manufactured anything or provided services, your business was wrecked. And then Wall Street had a rapid, miraculous recovery within 6 weeks of the pandemic, and they had the best year of their life. And I could have basically sat on a floaty in my, pool in the Hamptons and got a 30% return in that year doing nothing, which would be the best year of my entire business career if I'm a financier. But if I was running a restaurant or running a manufacturing facility or doing something with raw materials, I would have had to generate 30% more cash flow to get nothing.
Michael Saylor also expresses his concerns about the increasing money printing and the collapse of currencies in the recent times.
The value of the currency collapsed in the year. In essence, the Fed printed 40% of all the dollars in existence in the 18 months that followed the pandemic. So when Jerome Powell said, we're not even thinking about raising interest rates, and forecast 4 years of 0% interest, and when the Fed loosened the reserve restrictions on banks and allowed banks to, in essence, print infinite money with no reserve ratio, then the economy was flooded with liquidity. What happened was the stock market immediately recovered. People thought that was something good. It wasn't good. It was the money collapsing. It was the value of the dollar collapsing in real time against scarce assets. So most of the time, if you owned a portfolio of stocks, if you had $1 billion worth of stocks and your portfolio went up by 30%, you would have thought you were a genius in that year for doing what? For staying invested in stocks. Why? Because Jerome Powell printed 30% more money. Okay. If you didn't own a portfolio of stocks, if you thought you were going to work as a dentist or a doctor or do things in the real world, your business is shut down. The cost of all your materials is going up, your labor's disappeared, and no one's showing up to buy your stuff. The world doesn't look so good. So you had this dichotomy, I think, and the people on one side of the economy thought everything was just fine, and people on the other side of the economy got destroyed. I was sitting in the middle. I had a Main Street company that generated $500 million in revenue and generated cash flow. And I had a $500 million treasury that was sitting in conservative instruments, basically invested in short-dated sovereign debt. If the interest rates were 3 or 4% and the money supply was expanding at 2%, you might think that that was rational. When the interest rate goes to 0% and the money supply is expanding at 2 or 3%, it looks a little bit painful. But when Wall Street recovers 30% in a matter of weeks, when Main Street's completely shut down, and it's pretty obvious it's shut down, you're catalyzed to consider your premises, check your premises, and ask the question, is the economy 30% better than it was before the pandemic, or is there something else going on here? And I think the answer is there's something else going on here. The actual inflation rate isn't 2% or 0%. The inflation rate was 30%, but the inflation was hitting the assets. It wasn't hitting consumer goods. And so what I realized is maybe the money supply is expanding faster than 0 or 2% a year. And I started on a search and I discovered the Bitcoin standard.
Michael Saylor speaks about the importance of investing in a desirable scarce asset and how it can transform your portfolio. He also shares insights on MicroStrategy's decision to go all out with Bitcoin.
So in an environment where the money is losing 15, 20, 25% of its value a year, and you're sitting in all cash instruments, you either need to give the money back to the shareholders or you need to invest it in some scarce desirable asset. So the reason I did what I did at MicroStrategy was, if I gave the $500 million back to the shareholders, that was $60 a share. The stock was $120 a share. I basically was valued at 1 times revenue plus the cash. When I gave the money back to the shareholders, the stock was going to go to $60 a share. When that happened, all my employees' stock options were going to be underwater, right? And we were going to get beat to death by Amazon, Apple, Facebook, and Google. They were just going to steal all our employees when the stock crashed. And that would mean that instead of growing 5 or 10% a year, I was going to be shrinking 5 or 10% a year. Instead of my cash flows doubling or tripling, they were going to be cut to 0. And once your revenues start falling, your cash flows go to 0, you have no capital, all your employees quit. When your employees quit, the company unwinds, we're going to go to 0. So giving the cash back to the shareholders was a fast death. Holding the cash at 0% interest when it was losing 20% of its value a year was a slow death. Doing something was the alternative. And so we decided to do something, which is invest the money in a property or in an asset that would go up faster than the rate at which the money was collapsing.
Saylor also addresses issues of investing in gold and real estate. He clarifies his stance on Bitcoin as a superior asset as compared to other options, as it reduces security risks and the chance of government intervention.
If you took any amount of money, take $100 million in the year 1900 and invested in any currency in the world, you would have lost 100% of your money in every currency except for the dollar or maybe the pound. Every currency collapsed. The winner of every war in the 20th century was the United States. And so the winning currency loses 99.5% of its value. Everybody else, you lose everything. Now, if you put that money in gold, there's a 95% chance it would have been seized in the 100 years, because there's only a couple of cities on Earth, maybe Zurich or Geneva, where you wouldn't have had it stolen, and maybe then they still would have stole it, if you were the wrong citizen in the wrong country. If you were a Swiss citizen in Switzerland for the 100 years, you might have kept the gold. But, Churchill seized the gold. Roosevelt seized the gold. If you'd lived in Germany, you would have had your gold seized multiple times. In Japan, they lost it 2 or 3 times. In Russia, count the number of times. So there's nowhere on Earth where you could have kept your gold. Bitcoin is digital property that you can teleport anywhere in space instantly. And it's also perfected property with the lowest maintenance cost. You don't have the property tax you have on a building. You don't have to repaint the thing every 10 years. You don't have to worry about leaks in the roof. So if I could buy $1 billion worth of property and it was in cyberspace, and if you couldn't make any more of it, if I capped it at 21 million city blocks in cyberspace, and if I could hold it for 1,000 years, I might have a better idea than buying a city block in Manhattan or a building in London or even a company. And it's a lot better idea than buying 30,000 pounds worth of gold.
So what are your thoughts about Bitcoin's importance as an inflation hedge? Do you agree with Saylor or not? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.